Okay, guys, how you doing? It's 1:30 on November 27, 2012. As you guys know, here in Shine's Trading Room, we have a philosophy of ongoing education, ongoing mentorship, as this process is not a one-day or a two-day or a 4-hour lesson where a person masters something in a short-term time period like that. It's as if you were learning a language. It's as if you were learning to speak Chinese. It's as if you were learning to be in combat, let's say in the UFC or in boxing. And what I always talk to my traders about, I always ask, if you were your first day in the UFC and you really wanted to take up ultimate fighting, and you were going to hop into a cage with somebody, and that somebody was a master. And how would you guys fare if you hopped into that ring with them? And you can answer on the left, as we try to make this as interactive as possible. How would you fare against a KO? That's well put, Adam. Guys, to get my butt kicked, exactly. Destruction, terror, mayhem, champ, and so on. Not too well. You know what? I feel the same way with the stock market. I feel the same way with trading, right? How many people out there get into the markets and the first thing they do, they buy 400 shares of a volatile stock? And I'm not even saying the Googles or the Apples or the Pricelines of the world, but even people get in there first day, they're buying 1,200 shares of Monster on a day like today, or short it, getting beat up, not buying and entering at the right price, not being aggressive or passive at certain times, not knowing how to defend yourself, not having all the tools at your disposal. And you know what? Exactly, Frank. And what happens is people. What happens is people end up in a place where you need to have all these tools before you get into the ring. And one of the times we recommend that, we talk about education all the time. You have to get into education. Well, I think it's still an ongoing process, and every day or a couple times a week at minimum, we try to pass out to people as much as we can, education-wise, and understand some of the tricks of the trade, and understand at certain times, and be able to really be more of a master, be more of a trading master, as well as a fluent in the language, and as well as being fluent inside the ring. If you get into that. Exactly, Jason. If you get into the ring with somebody, and you just need to have all the tools, not only defense but offense also. So I put together a couple of quick slides just to show you the two different approaches, and I guess there's approaches in between also. But when you're trading, you could either have a passive or aggressive approach. And I believe BC might have said it this morning when he talked about, hey, I haven't gotten into any trades yet. I look at a day like today as there is, and even most recent, there is always a better time to enter that trade. And the only way you're going to get that better price and get into that trade at a better price is if you're passive. And when I say passive, I mean you're waiting for it to get to your level. I'm talking about you putting in a bid at your price or no price. And it could be on the short side also. You could wait until it gets to your level on the offer side, or not at all. As you guys know, which ones we buy and which ones we sell is for a whole different discussion. But on a blanket overall macro picture, we buy the strong ones, we short the weak ones, and we wait for our levels and our price. Not only that, with yesterday's education, talking about the blip trade, we actually know better than just our price, and this is for everybody. For now, don't just get your price. Get 5 or 10 or 20 cents above your price if you're getting short, or 5 or 10 below your price, 5 or 10 cents below your price if you're getting long, because it seems like this market, they're blipping people out in both directions, and it allows for you to take advantage of those blips. So when you talk about passive versus aggressive, you need to have the mentality of when to bid and the mentality of when to offer. And also when to take the offer or hit the bid. And remember those phrases in that language. It will help you overall in Shine's Trading Room, because you end up in a language where people say, hey, they're taking the offer, and you understand what the language is. The verbiage on a trading floor is very important, and especially in a trading room, it's very important. As you guys get in there, you need to know what people are talking about, how they're phrasing it, what they mean by taking the offer and hitting the bid, and so on. This is one of those exercises where I ask people to start by picturing in your mind what it looks like down towards the bottom part of a range in a stock. Down towards the bottom part of the range, you get the bid. It is just a quick mathematical formula of bidding versus taking the offer. This is for those professional traders, and this obviously varies at times. But how many of you guys know out there that you actually get paid, depending on your commission structure, but most professional traders get paid when you supply liquidity out there to the marketplace. When you put a bid out towards the bottom part of the range and somebody sells it to you on the bid, you're getting paid to do that trade. Most of the times we use a general formula of you get paid 0.2 of a cent in order to, when you supply that liquidity. And when you take the offer, you pay 0.3 of a cent. Guess what, guys? That's half a penny. 5,000 shares, it's $5. By getting hit on a bid, you're actually making $5. You're saving $5 on doing that transaction versus taking the offer. Well, guess what? Down towards the bottom part of the screen also, if a stock has a 2-cent spread, that's another $20 for 1,000 shares. So if a bid on a stock, I don't know, for example, let's say RIM, which happens to be fairly thick, let's say at a 2-cent range, instead of you getting hit on your bid price, and you now start taking the offer, you're paying $20 extra, plus you're not getting the $5 for supplying liquidity, or the $2 for supplying liquidity, and you're paying $3 to take the offer. That's a $25 difference. Let me ask you guys a question. For all you out there, and we have a large audience on today, how many people over a lifetime want to save $25 on every 1,000 shares that they trade? There's one. I assume everybody. Exactly. You know, some people may say, hey, my commission doesn't really matter, my system doesn't really matter, and I'm not really doing that much. Let me tell you, if you end up being successful, and I went through this process because, you know, in the late 90s, we paid probably 10 times, literally 10 times what we paid today, commission-wise. Technology was not as good, so you were getting beat up in all different directions. Bandwidth was not as robust. Exactly. Wait till the end of the year and you'll see what the bills look like. And if you could save $25 a thousand and go back to how many shares you traded throughout the year and throughout your career and throughout the month and throughout a 10-year period, it ends up to a ton. So, you know, today's the day where you start learning about bidding versus removing liquidity, and also being able to make and capture that spread. At times we call that making markets or being a market maker. I always do my best at first to try to make the market in that stock by putting out my bid. At times I go high bid, as we talk about, when I make the spread a little bit smaller. But my ideal spot to enter a trade is as close to the bid as possible without having to take the offer. So I could either be at the bid, 1 penny above the bid, or a couple cents below the bid if it gets to my price. And I forget who it was. Maybe it was Mary Beth, actually, who talked about just getting your levels, picking your levels early on, and being out there really early. So when your price does show up, you're getting hit at your price, your ideal price, and you're making the spread, and you're getting paid to supply liquidity to the marketplace, and it makes a huge difference overall. And I just, it's important for people to remember that there is a huge advantage. Okay, I'm going to move on a drop. We'll talk about a couple other ideas. A couple more advantages of bidding versus removing liquidity. It depends on the type of day. Some days you cannot cover your shorts because it's a strong day. This is just an example, and you have to take the offer. That's okay to do that. As we talk about trying to supply liquidity, if you don't get hit on a bid and now the stock moves out higher, I don't know, 1 penny or 2 pennies, it ends up costing you a lot more money than trying to take the offer right there at that price. So you remember, it's a battle between that passive and aggressive. We showed it on the first slide. This battle, at times you have to be the guy on the right-hand side. You have to be that aggressive, and you have to have the killer instinct. You need to have that killer instinct, and that comes with being a good trader. You know, a lot of people out there, they talk about people being able to, hey, I just want to hit singles every day. I want to make 50 or $100 a day. I don't believe in that, making the $100 a day. I believe in certain days you have to have that killer instinct. Certain trades that you put on have to be killer trades. You have to have doubles, triples, and home runs also in your portfolio every single month in order to really make it stand out. It doesn't have to be every day. Not every day you're going to hit a home run. But on an overall period, you need to find at least once a week where you knock the cover off the ball, and that's where the stats end up piling up. When we talk through our whole educational seminar, we go into 20, 30, 40 hours worth of this stuff, and which are the times and when and what day looks like and what the situation looks like in order to be aggressive. But at times you need to be the guy on the right. If you're the guy on the left, and I've seen it a lot recently where people are a little too cautious, people are a little too conservative, that you miss the trade. One thing you could do to protect yourself instead of missing the trade and not taking the trade and sitting there on the sidelines, one thing that you could do for yourself, utilize your stops. Make sure you're using stops on every trade. And when you have stops, you should feel protected to be able to put on trades and take small losses throughout, as opposed to having a big loss and not having a stop or not getting into the trade. I'd rather, on an overall basis, I'd rather see small losses on people's P&L, on people's screens, on people's stats, small losses throughout than any big losses. Okay, just going back to this formula one more time just to repeat, and then we're actually going to wrap it up as I try to add a little bit of information and education every day. Depends on the type of day. Some days you cannot cover the short. Certain days when your stock runs out. Let me ask you a question. Are you trying to bid on I don't know, Monster today, MNST, up, I don't know, 10, 12%? Are you trying to bid for that stock, or do you have to at times be aggressive in order to get in? Sure, you have to be aggressive, but remember, you still have to get down towards the range of your best price or no price, but at times you need to take that offer, and you have to be willing to pay up to take that offer, and other times you sit there and you're passive on the bid. For all new beginners, I feel like being passive on the bid and bidding for stock is an advantage for a newer trader, a more beginner trader, until you get to the point where you're getting more comfortable on which ones to take the offer and to get more aggressive with. It doesn't mean at any point should you be buying the top parts of ranges or shorting bottom parts of the ranges. Here's a lesson that we'll dive into. Maybe we'll actually talk about it tomorrow, but here's a lesson about certain entry points and certain exit points. This is what everybody needs to always keep in mind. And remember this pattern, remember this philosophy, remember this is how you're building your positions and building out of positions as close to this as possible. For all the you guys who say, hey, what should I do in my position here and there, this is a macro portrait of what you should be looking to do at all times on what type of stock and what type of name and how to build your position. Those could be 10 share lots, those could be 100 share lots, those could be 1,000 share lots, but that's how you piece in and that's how you piece out. We'll get into more detail as the week goes on, and we'll touch on a couple more points hopefully every day. I know I want to get to options over the next day or two just to grab a couple tidbits and pass them out to you guys. If there are any questions or any comments you guys want to talk about now, and if you guys want to that's a good question. And if you guys want to ask any stock breakdowns, technically speaking, or any insight, or even translation to the options market, let's do so now. We actually did get a question from somebody here, and somebody said, "Where is 4?" So I see a couple of you guys smiling and laughing. Where's number 4 on this chart? Believe it or not, it's actually done on purpose, because those are not entries. Those are not entries of which number you're getting in, but those are lots of stock, and that's building your position up to about approximately 1,100 shares. If you put in a 4 in there, you'd be at the wrong amount, and it's actually exactly Leo share lots. So guys, let's any question? EMC, VMW, a couple VMWs we're talking about. So let me bounce out of this for a second. Let's talk VMW. Here are two charts on a VMW. Left-hand side is today's chart. Right-hand side is more of a daily chart going back 90 days. Obviously, the stock just bounced out over the past couple minutes, so I guess maybe somebody was actually just talking about that or posting on VMW ripping out of the ordinary. Probably not more of a breakdown of the name, even though it did just pop its head up above that moving average that I watch, which I believe is the, let's actually check it out. that is the 50-day simple moving average, my line on my screen. And what it does, it just keeps me in check. And believe it or not, if you take a look at what some of these levels look like right here, stock below that 50-day moving average and then continues to break lower. Here's that blip trade on the right-hand side of the screen, as you could see in the beginning of November, blips above that level just to get back to 85, and now we blip up against above that level once again. So keep a close eye on it. Coming back now towards that $90 level in VMW. Just keep an eye on it, whether we settle out above and we continue to break through, or whether that becomes resistance as it's been over the past month and a half. That's on VMW. You guys want to... you know, good question, Doug. I don't know if anybody has news on VMW. As always, we have a revenues first environment, so if somebody has something you want to post, as we always do, continue to post it. Did you VMW and EMC? I guess those were the two names that people wanted to post that they were moving. Is that? Are we, Doug? Are you asking a question on SWI? You want to break that down a little bit? Another interesting name. Still middle part of the range right here, $55 on SWI. You know, those of you who have taken the class, what do we do with stocks in the middle part of the range? Do we go long? Do we go short? Middle part of the range. Do we go long or do we go short, guys? I expect some of my students. There you go, Leo. There you go, Jazz, David E. There you go, guys. Exactly. All well put. You know, all students of the course that you do nothing. And yeah, it's awesome. Keep pouring in anybody who's taken the class already. You do nothing in the middle part of the range. Why? Risk reward becomes bad. I'll tell you why it becomes bad. Because all you have is the upside move up to the top part of the range, downside move to the bottom part of the range, instead of being able to capture the whole entire range. So as you see in SWI, down towards 50 becomes a better purchase. Up towards 60 becomes a better sale. At 55, it's probably no trade for me. Thanks for that, EM. Go long and right calls, middle part of the range. Evan, a little bit more of an advanced lesson. We can address it tomorrow, but when you do that, you only bring in that limited amount. You limit your upside by selling calls, and if the stock goes down that $5 back to the bottom part of the range, you're probably not covered through $5 worth of selling calls. Anyway, guys, I don't want to make the education too long every day. Rather, have people be able to digest what we're talking about, and we'll address it again tomorrow as we continue an ongoing mentorship, ongoing educational process through Shine's Trading.